If you click on this video, I'm sure you want to make money investing. Originally, you bought some index funds in order to do so, but they only make 8% a year. It's going to take forever to make any money. So then you went down the Wall Street Bets route and gambled on deep out-of-the-money options on meme stocks expiring in one day. They actually have the potential of making you a ton of money, but the chance of actually doing so is not good, to say the least. You proceeded to lose everything. So what's the happy medium? What's a strategy that has much greater returns than index funds with much less risk than generative options? Well, it's the hedge funding's excellent adventure, which is developed by the titular hedge funding. This portfolio is genuinely one of the most powerful strategies I've ever come across while being extremely simple. Stick around until the end of the video to learn about how you can use it to make some insane returns. As you'll see later, it turned 10,000 to over $1 billion in 50 years with the same risk as the S&P, if not less. It makes use of leveraged ETFs, which enhance returns of the underlying. For instance, let's say you invest in a 3x leveraged S&P 500 ETF. If the S&P goes up 1%, the leveraged ETF will go up 3%, and vice versa for losses. I explain leveraged ETFs in detail in this video, which is definitely a great watch if you want to learn more about them after finishing this one. Hedge Funding posted this strategy on the Bogleheads forum in 2019. It uses the concept of risk parity, where all components of the portfolio, such as stocks and bonds, contribute the same amount of risk. For a regular portfolio, this is achieved with a 40-60 ratio between stocks and bonds. But that's boring, so this strategy takes those same allocations but with triple leverage, so you can actually make some serious cash. So here's the portfolio. UPRO, a 3x S&P 500 fund, makes up 40%, while TMF, a 3x long-term treasury bond fund, makes up 60%. Some people do allocate a bit more than 40% for stocks to take on slightly more risk in exchange for a potentially bigger payout. For this video, I'll talk about the original 40-60 allocation as well as the aggressive 55-45 allocation, which hedge funding now recommend using. You're meant to rebalance this portfolio, meaning bringing the two portions back to their original allocations once every quarter. By the way, I have links to M1 Finance pies with both of these allocations in the description. If you use one of these links to sign up for an M1 Finance account, you'll get $250. That's literally free money. By the way, since hedge funding's excellent adventure is kind of a mouthful, I'll refer to it as HFEA. Before we get into the finer details and rationale of the strategy, let's just do a backtest against the S&P to see what we're up against. Before I show you the backtest, I just want to take a moment and ask you to like the video and subscribe to Omni Capital if you're enjoying the video so far in order to boost this video in the cruel YouTube algorithm. As a small channel that tries to make quality finance content, it truly helps out a ton. No pressure though. As you can see, HFEA vastly outperformed the market. Assuming starting balances of $10,000, the original portfolio would leave you with $682 million. The updated portfolio will leave you with $1.34 billion, while the regular S&P would only get you a relatively measly $1.6 million. Well yeah, obviously leveraging during bull markets is going to make you rich, but here's the thing. This strategy does perform amazingly well during bull markets, so you'd expect it to implode as soon as things go wrong. After all, that's what happened to Bill Huang and a certain Wall Street Bets degenerate. But it doesn't. Looking at the drawdowns, it either performs slightly worse or even better during bear markets, with the only exception being 2022. For instance, during the Great Financial Crisis in 2008, the original allocation of HFEA was down 9%, while the regular unleveraged S&P was down 37%. This leads to have a much greater Sharpe or risk-adjusted return. How? This strategy attempts to capitalize off the fact that stocks and bonds usually have a negative correlation, or at least an uncorrelation. The purpose behind the bonds in this portfolio is to provide insurance against a crash, which would wipe your entire investment out normally. Using a risk parity allocation of stocks and bonds tends to have a higher risk-adjusted return than just 100% stocks, but at the cost of a lower actual return. We're compensating for this by using leverage. The fundamental problem with leverage is something known as volatility decay. It doesn't take a 20% gain to come back from a 20% loss, it takes a 25% gain. It doesn't take a 90% gain to come back from a 90% loss, it takes a 900% gain. This means that leverage funds take forever to recover after a crash. This is why we add TMF, so we're not completely wiped out when stocks crash. Unfortunately, the strategy performed pretty terribly in 2022, since both stocks and bonds crashed. This occurrence is pretty rare, but even during the subsequent stock recovery in 2023, causing UPRO to do great, TMF still proceeded to dump 90% from all-time highs. I guess Jerome Powell's infinite money printer can't save everything. This has people questioning the validity of allocating half to HFEA to a fund that's just literally burnt any money put into it in the last couple of years. You need to realize that this is precisely the volatility that you accept by investing in leveraged ETFs. I'll get back to this a little later. So now you probably have two questions in terms of the funds used for HFEA. First of all, why UPRO and TMF specifically? Or why are you investing in the S&P and long-term treasuries? Secondly, why only two funds? Isn't more diversification better when trying to maximize Sharpe? The answer is the fact that you're playing a different game because of leverage. You might want to diversify further into stuff such as small caps and international stocks, but since they tend to be more volatile than US large caps in the S&P 500, they'll have worse performance when leveraged due to volatility decay even if the underlying does end up outperform. For instance, if the regular S&P goes up and down 10%, our total return would be 1.1 times 0.9, which equals 0.99, meaning we're down 1%. However, investing in UPRO when this happens would yield a return of 1.3 times 0.7, which equals 0.91, meaning we're down 9%. Obviously not ideal compared to the underlying, but that isn't too bad. Now let's say hypothetically that during the same period, small caps go up 30% and then down 20%, since they're more volatile. Your return investing in a regular small cap fund would be 1.3 times 0.8, computed to a 4% profit. Nice. However, a 3x small cap fund would have a return of 1.9 times 0.4, which ends up to be a 24% loss. This is how volatility decay will screw you over. Because of this, the S&P 500 was chosen, since it is both diversified and relatively stable compared to smaller stocks and stocks outside the US. There's also the simple convenience of UPRO being a highly liquid fund as compared to some 3x international funds, which are much smaller. So then, why are we buying leveraged long-term treasuries specifically? Well, as aforementioned, the whole point of including bonds in HFEA is to provide protection against stock downturns with other assets that aren't correlated to stocks. Treasuries simply have a greater degree of uncorrelation than corporate bonds. Furthermore, long-term treasuries, which are the ones used in TMF, tend to be more volatile than shorter-term treasuries, so they can more effectively help against crashes on the stock side. So, should you invest in HFEA? Well, obviously don't take my words as investing advice, but if you wanted my opinion, it's a yes, but with a pretty big asterisk. Looking at the backtest, HFEA clearly works. The principle of leveraging a risk-parity portfolio in order to achieve great returns with less risk is simple yet effective. However, you need to keep in mind that you're still investing in leveraged ETFs, which are quite risky. I really would not put your life savings into this, because you risk a year like 2022, which can and will screw your entire investment over. But who knows, maybe put a small portion of your portfolio into the excellent adventure and it could truly pay off for you one day. Do you want to learn more about leveraged ETFs to truly understand the mechanics behind HFEA? If so, click this video and don't forget to get $250 for free by signing up for M1 Finance using the link in the description. Thanks for watching and I'll see you in the next one.